New reporting by the Washington Post shows Silicon Valley Bank was warned by its own internal risk assessment modeling that higher interest rates could have a devastating impact on the bank. But instead of listening to the warning, SVB executives simply changed the model's projections. Joining us now is Daniel Gilbert. He is a business of medicine reporter for the Washington Post. Daniel, good morning.
Good morning. Good to be with you.
Good to be with you. So break this down for our viewers. Tell us more about SVB's profit-driven strategy and how it ultimately led to the bank's downfall and why they would make these changes. Because
That's
so
the thing to
blatant.
me, is they had a process to determine risk factors. And when they didn't like the outcome, according to your reporting, I thought it was fascinating, they just tweaked the parameters. And so, now the outcome's fine.
Right.
I think a good place to begin with this is the amount of deposits that was flooding into the bank. They had an absolute fire hose of money coming into the bank during the pandemic. And that sounds like a really good thing, and in many ways it was, but it also is something that created some challenges in that they had to find a place where they could invest all of the money that was coming into the bank and at a time of rock bottom interest rates. And what they ended up doing was they went into the market and they bought longer term bonds and securities that would give them a higher interest rate than they could get with shorter term securities. And so they were able to earn more interest than they were passing along to their depositors. And for a time, that proved to be a very, very profitable strategy. They were able to increase their net interest income every quarter for about 2 years. The stock price tripled. And so that worked very well for them for a time. But there are two problems that they seem to have not fully appreciated. And one of those was higher interest rates, the effect that higher interest rates would have on buying those longer term securities. And so when interest rates went up, the value of those longer term securities decreased, which meant that if they had to sell, they'd have to sell at a loss. And that in and of itself, that would not have been a fatal problem, except they had another one, which is they had made some assumptions about how long their customers would keep their money in the bank. And those assumptions turned out to be wrong, and the customers withdrew their money much faster than the bank had expected. They had a liquidity problem, and they needed to go out and sell those securities at a loss. And so when they did that, try to raise new capital, well, that spooked the market, sparked the panic, and you know the rest.
I thought it was so fascinating because I thought one of the things that they didn't really factor in is the way we communicate now. That, it's at lightning speed, that people are online, they're having conversations, that it's easy to remove your money with sort of a click of the mouse in a way that it hadn't been, 20 years earlier. And so just once people started removing their money, the pace just kind of really sped up. I mean, did they have any warning, any sort of red flags at some point along the way before it was too late that they could have sort of reversed course or changed course?
It did, and in fact, it was quite early on. Sort of mid 2020 timeframe was when this strategy triggered one of these warnings from an internal risk model. It's one of their models that looks at their sensitivity to interest rates, something that all banks do, and this suggested that if there were much higher interest rates, that would have a very serious impact on their finance, on their future cash flows. And so they had that warning, but again, remember, this is mid-2020, early days of the pandemic. Interest rates are really, really low. There's not a rate hike on the horizon. And moreover, what they saw in this model from what our sources have told us was not what the senior executives wanted to see. Because it suggested that instead of buying these longer term securities that would pay higher interest, that they should shift into shorter term securities that would pay less interest, but would be less vulnerable to higher interest rates, or that they should add some hedges. But none of those course corrections would have delivered the kind of profitable quarterly growth that they wanted to be able to show.
I think it's so interesting that you can have sort of the best software, the best sort of engineers, but what we have, the X factor is always human emotion. It's what led to the run on the bank. It's what led to them, to bank executives making, not the best decisions because they had sort of a roadmap.
Yeah.
Daniel Gilbert, was really interesting read. Thank you so much.
Thank you for having me.